And now I would like to introduce the man of the hour, Vijay Rajendran. He is the Director of Innovation and Partnerships at 500 Startups. He works at the intersection of startups, investors, and corporate innovation, and has previously worked with developing partnerships with fintech startups. And he has additionally worked directly with entrepreneurs and residents at Global Bank BBVA in San Francisco. With that, I'm going to pass it off to Vijay, who will explain more about his experience in innovation, and then we're going to start the webinar.
Thanks, Patrick. It's great to join everyone this morning. We are looking forward, as Patrick said, to our program in Paris next month with INSEAD. Of course, it's a sad week for the people of Paris, and also has been for those of us in our office whose thoughts are with that great city experiencing the loss of Notre Dame this week. So with that, though, we recognize that there is such a thing as renewal, and that renewal that is part of innovation is what we're sort of talking about today, and that is when it comes to results-driven innovation in the corporate landscape. And as Patrick said, I have a background where I've sat in many different seats around the table, working in the corporate innovation world, as Patrick mentioned, at BBVA, where I led the venture design program. In addition, the time I spent there, I was also leader of a digital bank for small business, now known as Aslo, starting that as an entrepreneur. I've also been an entrepreneur, starting a e-commerce company focused on the gourmet subscription space, and have a previous background as a designer and also a management consultant. So a long and winding road, certainly to venture capital, but with some experiences I think will be helpful for folks who are joining us for this webinar. So here's what we're going to cover today: results-driven innovation, with the objective that you'll have an understanding of what we mean by that term, and give some examples of what it looks like, as well as some major principles for that. We'll be sharing some tips on how to make your teams more results-driven, and certainly with anything, we hope that this is just part of a longer conversation that's happening inside of all of your organizations, and that folks reach out to us at 500 Startups, as we hope to be a resource for people such as yourselves. For those that aren't familiar with 500, we are a global venture capital firm. Our mission is to discover and back the world's most talented entrepreneurs, help them create successful companies at scale, and build thriving global ecosystems. And that is chiefly why we're so involved in the corporate innovation landscape. As many people know, we're a global firm, the most active VC at the end of last year, according to PwC, offices in 20 cities, and a number of investments now around the world in dozens of countries. We've invested over the years since our founding in 2010 in over 2,200 companies. We have now officially 11 unicorns in our portfolio, and we've had committed capital of over $454 million. So why does a VC firm care about corporate innovation? Well, as I alluded to before, the development of ecosystems is really important. And as we tend to be a seed stage investor and also an investor in many new emerging or even frontier markets, as a result, we believe that you can't go it alone, and certainly you need a vibrant ecosystem of universities, of public sector entities, of corporations, and also, of course, of entrepreneurs and investors. That's certainly true in our home base of Silicon Valley. And while we recognize every model is different in the world, one thing that is perhaps important for us to help catalyze is the innovative capacity of corporations and many of them that wind up being our corporate partners in one form or another. So that's a little bit about us. We'd love to know more about you and who you are in this webinar. So we're going to open up a poll for this question, and we'd love if folks can respond to describe themselves.
So you should see the poll launch now, so feel free to respond. Maybe about 10 more seconds and then we'll close it out. All right, well, it looks like the majority of the attendees are innovation leaders, followed by venture capital investors. We have some consultants and some C-suite folks. Coming up at the very bottom is some R&D folks, designers, and then, of course, we always have baller shot callers, but only 3 of them. So hopefully everyone's a baller shot caller, but apparently there's only 3 in this group. So yeah, the majority is innovation leader.
Wonderful. Thanks, Patrick. And thank you all for sharing that. And yes, you're all ballers and shot callers in our hearts. So thanks for that feedback. We'll definitely tailor this more to the innovation and the venture capital end of the spectrum. But you know, as people have questions, whether it's about R&D, whether it's about you know, C-suite topics that relate to this, you know, we have time in Q&A to cover that. So with that, let's move on to Corporate Innovation 101. So just to set the stage, because when people use the term innovation and discuss this topic, it means many different things. But certainly, you know, one thing that is apparent to everyone is that the average company lifespan in the S&P has declined, and it's going to get shorter and shorter. So, you know, whereas once, you know, a company could spend half a century in the S&P, that will, you know, soon be reduced to about 13 years. So with that kind of churn at the top, you can imagine the impetus for change and requirement to innovate. So I don't think anyone wants to lose that investor base. I don't think anyone wants to drop out of the S&P. And so I think we can say this is critical, and this is not just like nice to have. And what's different though about the current landscape as opposed to in the past is we're in this new world where it's not the big fish that eats the small fish, it's the fast fish which eats the slow fish. And that speed is really important. And so everyone on this call, whether they are in design, whether they are leading innovation from a product standpoint, whether they're, you know, investing, it's really important that they continue to prioritize speed over perfection and the rate of learning over the immediate returns. And we'll talk a little bit about why that's important. So startup innovation, sounds like everybody is doing it, right? This is on the tip of everyone's tongue. That certainly seems to be the results of some of our research. So 68% of top companies from the Forbes Global 500 are engaging with startups, and 61% of unicorns, that is companies with more than $1 billion of valuation over market cap, have raised from at least one corporate innovation team or a CVC. So clearly there's activity, but is that working? Well, certainly everyone is trying it, but things are far from perfect, and would love to, you know, have a dialogue certainly when we get to Q&A about what your experiences are. But we've captured some high-level perspectives on what we think is happening here. So the thing is, most people are using the wrong tools, and they're frequently disappointed with the outcomes. I was speaking with a global bank that has innovated for some time and is a leader, but they expressed some concern about their startup challenge. And in learning more about what that was, it was that they were able to get a lot of interest and measure a whole lot of participation, but the outcomes were frequently things that they couldn't use. And this is a consternation of innovation leaders, of CEOs, of people we've talked to in every industry. Is we do a whole lot of stuff, but I'm not really sure if it's useful. I don't really know where this is going. The companies we're talking to are early stage, and whether it's some flavor of those observations or all of them, that is totally common, because we need to have the right tools to do this kind of work. And those tools need to be combined with a different kind of mindset, because certainly the application of what we're trying to do is really different than the typical business strategy process, which is about the selection of the right choice or the optimal choice from a range of possibilities. So we're really turning that upside down in many ways. So let's dig into that a little bit deeper. So the reason that the tools aren't always effective, or the mindset may be wrong, is that, as we know, traditional corporations are structured for efficiency. So that means they're very good at doing things, but the attitude towards change is slow, but targeted towards innovation. But again, like very slow. Risk appetite is risk averse. A lot of people thinking about what they have to lose professionally as opposed to what they have to gain. The operating model is, as many people will have experienced, structured silos. The team structures are hierarchical. Incentives are based on year-end bonuses, which don't really account for long-term value creation. The measurement of success is short-term wins. Even for people who want long-term benefits, they still struggle to generate short-term wins, or find they have to do that. And results are usually measured in terms of effort, as opposed to other valuable feedback. And the outcomes as a result are generally financial, and people impose tools like payback and so on for investments which don't necessarily lend themselves to that kind of thing. So let's dig a little bit deeper into some of these. The biggest one has to be the attitude towards change, because while everybody knows, yes, we've got to do things different. We're tackling digital. We're going to be more innovative. You've got to move from whether not just from waterfall, but from slow towards fast. And certainly the best way to get faster is through an agile process, but also one that is very fast moving. The feedback loops that we see are still way too long. It can, in many traditional industries, it still takes 2 years to launch a new hardware product, where it's still taking many years of consumer insights leading to a perfect strategy documents to finally a process of building a product, when in fact some much shorter investments or learning opportunities could both de-risk the project, buy time, which is invaluable, and certainly also improve the rate of this kind of innovation. The risk appetite. So this again is where one realizes how hard it is to innovate and start of a large organization. So when we say innovation, there are of course different kinds. There's incremental versus the truly disruptive, and even disruptive has different flavors to it, depending on whether you're talking to Clay Christensen, the originator of this term, or various like new takes on this, for whether it's coming from a Peter Thiel or the Ray Kurzweils of the world, or others. And if we look at traditional corporate innovation, of course, its incrementalism is a reaction to risk aversion. And of course, its incrementalism is about like not losing resources and being a good steward of them. And that, of course, has an Achilles heel in terms of like making one slow. And so we believe in more exploratory approaches to doing different things, because that way it doesn't feel like the alternative to incremental innovation is a moonshot. It feels that way. If everything has to be a moonshot, well, then there's just going to be a litany of failures and a lot of like huge projects. The way to like look at what innovations out there today, to run smaller research and pilot projects can actually be a nice middle ground that some companies are exploring, but most are just sort of touching the tip of the iceberg in terms of where that should fit into the portfolio of their activities. And if there's any way to manage risk, it's through portfolio diversification, of course. Now shifting into the operating model. So traditional corporate innovation has, of course, operated in very structured silos. And that is, of course, about the efficiency gains of operating that way. So whereas we know that that's not how a startup would operate, and one would certainly have to be far more collaborative. We think that to get at results-driven innovation, you've got to create like smaller teams. I mentioned Agile before, but also teams that are hybrid. So you can find the people that are, of course, expert in one area and put them all together. But if you find the T-shaped individuals, then they are extremely effective and good leaders for just being able to do like 3 jobs at once, which is typically the case when you're trying to be results oriented and driven in your approach. So the team structure, we mentioned how hierarchical, how siloed things are. Certainly that lends itself to hierarchy. When you can have distributed teams for results-driven innovation, that's really helpful in the organization, because that's also one of the ways in which you can generate adoption. Because as much as it is a where to play question, it's also an adoption question for your customers, and then also for the organization itself. By bringing people from all over, by almost letting them get infected with like the approaches of agile or of open innovation or other tools that can be applied correctly to the problems they're trying to solve, they can take things back and they can kind of carry the torch in the organization. And so the team structure is beneficial, not just in terms of bringing the insights and helping form a diverse set of perspectives, which is really valuable, as opposed to folks who just sit in a skunk work style org. But also in terms of adoption into the organization, you need that from a change perspective. Incentives matter a lot, and certainly people have kind of just adopted a traditional corporate bonus structure. What needs to happen is move to a world of ownership. Not all of this is, of course, monetary. Some of that is is psychological as well. By creating a world where your ventures you're incubating or your projects you're incubating have owners, and they see themselves as having autonomy, that matters a great deal, and where they can tie some of their upside to performance of the this project, and not just to a larger division or the corporation at large. One can really do a lot in terms of activating people's motivation and also just get them to stick with it for much longer than they would normally. People don't need to own the failure of things that don't work. At the same time, though, we want to celebrate successes and give people clear rewards, because that sends a signal to the company that this isn't just people tinkering with toys and playing. They are doing real important and, of course, valuable work for the organization. So measuring success, of course, we've talked all about short-term wins and allude to that, but more than just the quarter-to-quarter earnings bias, the long-term commitment that is aligned to a mission is really, really important. So, for example, 500 Startups works with GM. GM has a mandate for 000. That is, zero crashes, zero emissions, zero congestion, and moving to a mobility future. And that has influenced the kind of people that advance in the company. It has aligned incentives for like the kind of assignments you get. As we know, the president of GM went to become CEO of Cruise. Importantly, for I think the kind of ways in which a company like that decides to play in the innovation landscape, GM has a partnership with 500 Startups to sponsor a mobility accelerator track, and that's a great way certainly to then align a long-term commitment aligned with mission, and of course a seriousness of moving to a future vision that influences lots of different innovation efforts. So results. The big idea here is, of course, that people measure effort and volume. They're looking at quantity. They're not necessarily able to also evaluate quality. So the impact and practicality of what we're doing is really important here. So you may find in your organization that people start projects and then don't kill them. So having a hypothesis, something to measure, looking at the impact of something, and killing things quickly is actually something positive, because the idea should be that the resources get reinvested into new things, or maybe there was a way to fail forward and certainly like learn. And so that generates not just additional volume and project for the sake of more projects, but it requires a cultivation of a portfolio of things that looks not just at the volume that things are going through, but certainly their relevance, and managing a portfolio of ventures, of internal pilots, of things like that are really important, because then you can compare and contrast. Because when people usually start things off, they do one thing in isolation, they stop and they start another thing in isolation. But certainly with a portfolio approach and the ability to look at the impact of one thing against another is the only way to get into effective measurement. Recently talking to an insurance company that I've known for a while, where they expect to replace 50% of their revenues in the next decade. This is very, very true, because they don't have the time to start and stop different things, and so they need to match the quantity of things with a high quality of impact, and only by measuring and contrasting against portfolio can that be done. And that means there has to be a bias towards learning. So financial results, thinking about what is the ROI on everything and exclusively that is necessary, but not sufficient by any means. And so your rate at learning is really important. Good product managers in your organization already do that. So the best product managers and who can make themselves a CEO of a product can also do that with the rate of learning at which they want to look at new things and how that can translate into big opportunities for the parent corporation without certainly latching yourself to a number of highly speculative and really expensive moonshots. So the first step for anyone trying to digest all those recommendations, and of course these are topics that we're going to dive into a lot deeper when we are at our Venture Capital Unlocked program in Paris next month, is of course cultural. So I'm going to stop there and speak a bit more about this topic. What does that culture need to do to become results driven? We need to go from slow to agile and fast, from risk averse to exploratory, structured to collaborative, hierarchical to distributed, from year-end bonuses to thinking about more creative ways to give people ownership, short-term wins to long-term commitment, effort to impact, and financial results to the rate of learning. To get there, there needs to be some tools for innovation, and certainly like those tools to be effective need to include a number of internal and external efforts. So one can be the M&A and to acquire startups. The other can be investing externally. You can build internally and spin off. There are accelerators, there's events, there's support services, there's pilots and POCs, and also co-working and labs. And so it's not a mutually exclusive set of things to do things internally or externally, or to only acquire and not to build and to spin off, but really managing a portfolio of new things requires a number of tools that, when used together, can be effective. And the best innovation leaders recognize that they've got to be all-round innovation athletes who can use these tools. And of course, if they've got a distributed team, you take advantage of the fact that they need to have digital BD and marketing partners. They need to have corporate development partners. They need to have, that's internal. And then certainly they've got to have external partners who are either VCs, accelerators, or others that can help them. So in broad buckets, of course, we're trying to build, buy, partner, invest. In some areas, there are more focus, in others, more optionality. In the last few years, we've seen a bias for folks to go from traditional R&D through a trend of design thinking towards, in the last few years, more CVC investment. But perhaps because the focus areas have changed so much, the impact and effectiveness of all of those tools may not have been as successful as people have hoped. And so what we would advocate is taking a real hard look at how these things are being applied and improve them in the organization. Usually, again, by making some changes in incentives and making sure that the teams are more diverse. I think that's generally the biggest thing in terms of bringing people who are not just in innovation and making it everyone's job, but making sure everyone gets to use those tools. And the structured approach then, in which we start adopting that toolkit and these big buckets, of course, winds up being a range of things where first you're trying to sense, you want to identify the risks and opportunities for exploration. We're going to learn, define, and align priorities for those experiments, test, to conduct some high intent testing for those chosen areas. And this is where that hypothesis approach and a number of KPIs really matter. And then investing. So placing the strategic bets on the most promising areas. And again, using that full range of the toolkit. Sometimes that investment looks more like a partnership than perhaps a writing of a check for a stake in a company, or funding a new project from an internal build perspective. And then finally, with a number of things going, put someone in charge of accelerating it. So have an individual or a team in your organization really look at how to scale up the proven products, capabilities, be measuring the rate at which you're learning. That will actually improve both the quality and the throughput and velocity of what you're trying to do. So with that, I'm going to stop. I think that's been about 30 minutes and give some time for Q&A.
All right, so if you could please put your questions in the Q&A function at the bottom of your screen. And we do have one question right now. So this is from Ricardo. Do you see corporate venture capital more successful as lead investors or follow on with established VCs?
Thanks, Ricardo. That's a great question. So the CVC investors that we've observed are typically following on because of reasons that relate to their internal governance. They often are not able to lead rounds or even sometimes take board seats and things like that. I think if CVCs though are going to look at companies that may represent future acquisition targets, things like that, they may benefit from leading a deal, but of course that does kind of mess up the cap table at times for companies that want to leave their options open. So this is actually a really great conversation in terms of like, are the incentives aligned between that company that you want to invest in and what is right for the CVC. I think as a rule, understanding why you have a CVC program. Is it to hunt for future M&A targets, or was the organization set up in order to invest in businesses that you couldn't build yourself, or was it to learn? And if it is more of the latter, then the follow-on deals where there's a combination of information rights and some strategic value in terms of partnerships is more than adequate. So again, if there's a high intent around the kind of investing that's being done, it kind of lends itself to one thing or another.
Great. So I love this question from Ko Ohashi. And so how can we measure kind of success and learning? Is there any sort of metrics that you would recommend for a corporate?
Right. So the typical units of measurement tend to be number of projects, dollars spent, and people working on the efforts. That's if they're internal. And some variation of that is applied if they are external, certainly in terms of investments or commitment to partnerships and things like that. While those are useful to track, I think we really need to go much further in terms of what we're trying to get out of this, such as like, can this be a way to save on internally developing things? So if someone has the the ability to do a build versus buy analysis and say, well, by piloting something, it's much cheaper than going out uh, and making an acquisition and seeing, do we have something that can scale, and sometimes that build versus buy analysis pays off. Separately, there can be a long-term interest to enter a certain area or acquire a startup. Doing a partnership and exploring just where the value is in the IP, in the go-to-market, in the adoption, whatever, can make a ton of sense. I think the other thing to measure is rate of engagement, because there are a lot of challenge, and again, it depends on your industry, but certainly for more B2C industries, there's a high level of engagement between startups and sometimes and their customer base than between more mature companies. Maybe because the channels are digital, or maybe because the brand is a challenger brand and resonates more strongly. But in those cases where you're looking at higher NPS or at some other kind of measure of ease of doing business, then you want to look at those things as well. And that can be nice to have in some industries, and it can be totally critical in others where you see that lack of engagement leading to a attrition rate in the user base. So depending on how fast your platform is burning underneath you, the approaches here to measure can actually be quite diverse, and particularly if it's on the consumer level. Of course, alternatively, if you're looking more at the innovation partnership or investment from an IP standpoint, you've got to develop models that allow you to analyze and look at the metrics of what you're paying in versus what it would cost you to just like pure license and then subsequently build things as well. So start with a build versus buy, and then add on various layers related to customer success.
Great. And so now we have a question from Roberto. So what is the difference, if there is any, between kind of the first wave of CVCs about like 15 to 20 years ago and today's wave of CVCs? Do you see any difference or change in methodology?
It's a great question. So I think the first wave of CVCs were folks that didn't really have a playbook, but knew how VC worked, and they were able to make investments with a number of like often financial returns in mind, to invest off the balance sheet and so forth. What we're seeing now is like a great deal more autonomy for CVC. In many cases, people still have to send things up the flagpole and maybe get a sponsor inside of a business unit or something like that. But I think the overall autonomy is pretty high. So the trend has been over time, if I can overgeneralize, people start doing corp dev that includes looking at venture. Someone who's used to buying billion-dollar companies is sort of scratching their head about like, is this the right use of my time to make $5 million investments? And so you end up building a venture team. That venture team then starts making investments off the balance sheet. They find the decision-making speed inside the organization is way too slow, and then seek some further autonomy and also an understanding of how much capital they have to work with. So they may have a dedicated pool of capital that changes perhaps into a single LP fund, and then eventually there can be spin-offs, as we've seen with the likes of Scale or Sapphire leaving a B of A or SAP. And so with that sort of been the evolution over time, but the impact, I think, more broadly, even for the newer organizations has been, just an understanding that there is more autonomy. There's an expectation that you're going to feed back information into the organization, and that is really hard because it's hard to be an investor and then also like an evangelist in the company. So I think that's where the CVC's job has gotten harder, and perhaps if I can say one area where it's gotten easier is we're seeing more CEOs showing interest though in the CVC portfolio, and recognizing that there's more optionality there. So that is probably a good thing, and the silver lining for all of the additional burdens that some CVCs have in terms of transmitting the things that they have learned into the parent organization.
Great. So I love this next question as well from Jason Miles. So how does the structured approach scale across a global organization? I think 500, Vijay, you yourself probably have some good insights on this. What is your view on decentralized versus centralized innovation?
I think when you're trying to solve for a very local problem, of course, like centralized innovation is really easy. The problem though is often defined by the nature of the users, and so if you're trying to do something in one part of the world, intended happy. There are things that people are learning from implementing it may not even be a real a product in of itself in one part of the world that should be transmitted elsewhere. And so when you have a distributed team of innovation leaders who are running a portfolio of different projects or investments, then feeding that back is very powerful and allows again that rate of learning to go up. So it is tactically very hard. It is sometimes expensive to do. People don't have the headcount to pull it off, but that's where you kind of lean into the toolkit and then say, well, who can be my partner organization in another country, or who could we do this in consortium with other corporates in a similar in a similar space, or maybe adjacent, and we're not competitive with. And I think that is one of the future opportunities is bringing companies together in a more collaborative way. That there are a few different people doing that right now, and certainly 500 is one of them, where either by our investments or the corporate innovation and partnerships program we have, we're able to unlock the innovation in different parts of the world for our different corporate partners.
Amazing. So, so here's a question from Gerald that I really like. So how do you account for innovation projects that fail? So in terms of learning from failure, and if you're selling your corporate or whatever about innovation, how do you make sure that they continue with innovation if something fails?
Yeah, that is going to be hard. So I think you've got to first build confidence with the overall program, and not just deliver short-term wins, but have a number of things that pay dividends while you're working towards a long-term result. And so there can be some failures along the way, but if there are some ancillary benefits, for example, a new way to onboard a customer, and a previously unknown application, or or target segment for a piece of hardware that you develop for one thing but could plug in somewhere else. Those are all like very positive side effects or dividends from the process. I think the biggest thing is when something gets scrapped is one, to recognize how it was a way to fail cheap and to fail forward. And that includes ensuring that the people that worked on that project, they're, they don't need to, hang their heads in shame. They're certainly going to be celebrated, people who know how to take risks and learn, and then they move on to the next project. Like their careers can't be over. So that's the first thing. And secondly, if you're measuring the rate of learning, you're thinking, oh, by running this project and then perhaps shutting it down quickly, it wasn't a failure, but actually it saved us from spending $100 million to buy some startup, or it taught us that actually this isn't something that we can do ourselves. We should try and partner with someone else who can. And those are extremely hard lessons to learn. And usually when you say, well, we're going to go to that M&A or partnership route, the ideas never leave the strategy deck. And so I think some effort and learning, but in a sort of time-boxed and bucket-sized way in which you're trying to get a response back is actually very valuable and can really help the organization have a bias towards action and a bias towards change that may over time redefine the idea of what failure itself is.
Fantastic. So I think we have time for maybe one more question, and this is basically a conglomeration of many questions. So how do you convince your corporate or your firm or whatever to become more, to do more innovation? So how do you approach your superior or approach your team and convince them to innovate?
The biggest sort of impetus for this is usually some level of C-suite appreciation, and it's very hard to get people to understand something in the abstract or when they have problems. And think about how hard it is to get real global action on something like climate change, because we know what's happening, we know it's going to end the world, but it seems very far off, and it seems like there isn't something we can do about it. And so I think as you show how quickly things have changed and can tell a great story in that looks like the new behavior of your customers, the rate of attrition, that you have something to lose perhaps in your business because maybe you're focused on an aging segment, or you count on people to stay in hotels when they're choosing to stay in short-term rentals, or not to own a car or anything like that. Like if there's a shift, then that's always the best trigger. And so from that trigger, and with an understanding that what seems far away is actually very close, what people will feel is there's nothing they can do about it. And instead saying, okay, there are some tools, and one of them can be to start inexpensively with like insights and learning about the big shifts that are out there, and then putting a few people on it. You don't have to like free up budget. You don't have to cancel many big plans. This shouldn't create friction, but if you can get a few people who are part of a task force who are going to like start looking at new initiatives and then create excitement around that, then that's the biggest thing. There are folks that kind of look at the approach of FOMO and say, well, hey, if there's some fear of missing out, our competitors are doing this, we should too. That kind of competitive response is usually, usually inadequate, because you're not going to be able to be customer first and future oriented. So if you're always looking into your rearview mirror of what your competitor just did, you're going to be a second-rate version of them. So the best innovation leaders are like setting the stage, usually with their CEO for the kind of company that they want to need to become, based on that changing world, and helping people see how much closer it really is than they thought.
Great. So I think that's all the time we have today. Thank you so much, Vijay. And there are a million other questions that unfortunately we couldn't get to, but we do have a list of the questions. So if we find the time, and some of them are amazing, I'll send them to you, Vijay, and hopefully we can get back to the questioners as quickly as possible. And we are going to send out a recording of this webinar to all registered participants. So if you missed something, feel free to rewatch at your leisure. And yeah, if you want to learn more about results-driven innovation, corporate innovation, things like that, please check out our upcoming VCU Paris program. That's going to happen on May 13th and 14th. Vijay himself will be one of the instructors. So definitely that's a huge plug there. And you have to remember to get your application in as quickly as possible. We only have a few spots left. And reach out to me at patrick.driscoll@500startups.com if you have any questions. And Vijay, any final words?
Thanks everyone for joining us today. We'd certainly like to keep the conversation going. Feel free to tweet me or send us an email. Always happy to meet new people who are working in this space.
Yes, and you see his email address there. So with that, thank you everyone. Have a good rest of your day, evening, night, wherever you may be. And yeah, that's about it.